Okay, so you want to own a movie theater. It feels like one of the most exciting businesses in the entertainment industry. Every weekend, families, couples, and groups of friends line up to buy tickets, grab popcorn, and settle into their seats. Blockbuster films can attract thousands of people in just a few days. During major releases, parking lots fill up, auditoriums sell out, and concession lines stretch across the lobby. From the outside, it looks like a business that prints money every time Hollywood releases another hit. But that's where the mental model breaks down. Because the movie theater business isn't really about movies. Read that again. The biggest blockbuster of the year might fill every seat in your building, yet you could still struggle to make meaningful profit from ticket sales alone. That's because a large percentage of every ticket sold goes back to the film distributor, especially during the opening weeks of a new release. In some cases, the theater keeps only a surprisingly small share of the ticket revenue after the studios take their cut. So why do investors still buy movie theaters? Because the smartest operators understand something most people completely overlook. The movie isn't the product, it's the attraction. The real business begins after customers walk through the front doors. That's where high-margin concessions, premium experiences, memberships, and operational efficiency determine whether a theater becomes a profitable investment or an expensive real estate headache. And that's where the economics become far more interesting than most people ever imagine. Now, not all movie theaters operate the same business model. From the outside, they may all look similar. A large screen, comfortable seats, and a concession stand. But behind the scenes, the economics can be completely different depending on the size, location, and target audience. The first tier is the independent neighborhood theater. Purchasing an existing location can cost anywhere from $500,000 to $3 million, depending on the building, number of screens, and local market. These theaters usually operate 1 to 4 screens and rely heavily on community support, classic films, or independent releases to stay competitive. The second tier is the modern multiplex. These theaters typically feature 6 to 16 screens, digital projection systems, premium sound, and a much larger concession operation. Building or acquiring a multiplex often requires an investment of $5 million to $20 million or more, depending on the location and size of the property. The third tier is the premium luxury cinema. These locations combine movie screenings with reclining seats, in-seat dining, bars, private lounges, and premium experiences. Developing one of these facilities can easily exceed $30 million, especially in major metropolitan markets where real estate costs are significantly higher. So far, so good. But choosing the right category is only the first decision. The purchase price gets you into the business. Keeping every screen profitable, every seat occupied, and every customer spending money is an entirely different challenge. Now, here's where most aspiring theater owners underestimate the business. Buying a movie theater is only the beginning. Before the first ticket is sold, you may need to renovate auditoriums, replace projection systems, upgrade sound equipment, install luxury seating, modernize HVAC systems, and remodel concession areas. Even a single digital cinema projector can cost tens of thousands of dollars, while a complete auditorium renovation can quickly reach several $100,000. Building a brand new multiplex can easily require an investment of $10 million to $50 million before opening day. Then come the hidden operating costs. Electricity is one of the largest ongoing expenses. Massive projection systems, climate control, lighting, and kitchen equipment operate for long hours every day. Employee wages continue whether every seat is filled or nearly empty. Property taxes, insurance, software licensing, equipment maintenance, security, and cleaning costs never stop. On top of that, distributors take a significant share of ticket revenue, especially during the first weeks of a blockbuster release, leaving theaters with much smaller margins than most people expect. And then there's occupancy. Every empty seat represents revenue that can never be recovered. Once a movie starts, an unsold ticket disappears forever. That's the financial challenge. Many people think they're investing in an entertainment business. In reality, they're managing a capital-intensive operation, where expensive real estate, fixed operating costs, unpredictable attendance, and constant reinvestment determine whether the business generates consistent cash flow or quietly loses money month after month. Now, here's where most people completely misunderstand the movie theater business. They think the money comes from selling movie tickets. It usually doesn't. Ticket sales bring customers into the building, but the real profits often come from everything that happens after they arrive. Popcorn, soft drinks, candy, nachos, hot food, alcoholic beverages where permitted, premium seating, loyalty memberships, and private theater rentals typically generate much higher profit margins than ticket sales. A customer who buys only a movie ticket may contribute very little profit, while another who purchases a large popcorn, 2 drinks, and snacks can become far more valuable to the business. Think about it like this. Imagine 2 customers. The first buys a $15 movie ticket and walks straight into the auditorium. The second buys the same ticket, then spends $25 at the concession stand. Both customers watch the exact same movie. But the second customer often generates significantly more profit because concession items carry much healthier margins than ticket sales. That's why successful theater operators don't focus only on filling seats. They focus on increasing the average spending per guest. Premium food, loyalty programs, luxury seating, private events, and faster concession service all increase the value of every visitor. Read that again. The movie attracts the audience. The concessions generate the profit. Once you understand that simple equation, the economics of owning a movie theater look completely different. The film fills the seats. The spending outside the auditorium determines whether the business actually makes money. So, if movie theaters can welcome thousands of customers every week, why have so many operators gone bankrupt? Because packed auditoriums don't always translate into healthy cash flow. Movie theaters are burdened with high fixed costs. Rent or mortgage payments, employee wages, utilities, insurance, maintenance, and equipment financing continue whether every screening sells out or only a handful of people show up. When attendance falls for just a few months, those expenses don't disappear. Then there's debt. Many operators invest millions into luxury seating, digital projection systems, and large facility renovations, expecting future ticket sales to cover the loans. But if blockbuster releases underperform, consumer habits change, or economic conditions weaken, revenue drops while loan payments remain exactly the same. History provides a powerful example. In 2020, Cineworld, one of the world's largest movie theater operators, faced enormous financial pressure after prolonged theater closures and heavy debt. The company later entered bankruptcy proceedings in the United States to restructure billions of dollars in obligations. Another example is Reading Cinemas, which, like many theater operators, experienced significant financial strain during the pandemic, as attendance collapsed while fixed operating costs continued. The lesson is remarkably consistent. Movie theaters rarely fail because people stop loving movies. They fail when debt, declining attendance, rising operating costs, and changing consumer behavior combine to overwhelm a business built on extremely high fixed expenses. So, after everything we've covered, is owning a movie theater actually a good business? The answer is yes, but probably not for the reasons most people think. A well-managed movie theater with strong concession sales, efficient operations, and consistent customer traffic can produce annual net profit margins of roughly 5 to 10% after operating expenses. Exceptional operators with premium formats, luxury seating, diversified revenue streams, and prime locations may occasionally earn even higher returns. Most don't. In an optimistic scenario, an owner who controls debt, maintains high occupancy, and maximizes spending per customer can build a profitable entertainment business while benefiting from long-term real estate appreciation. That's the outcome every investor hopes for. The realistic scenario is far less glamorous. Attendance fluctuates, blockbuster releases are unpredictable, streaming platforms continue to compete for consumers' attention. Labor, utilities, and maintenance costs keep rising. A few disappointing movie seasons can erase an entire year's profit. Now, here's the lesson. The operators who succeed don't obsess over selling more tickets. They obsess over increasing the value of every customer who walks through the front door. Because the movie isn't the business, it's the attraction. The concessions create the profit. The experience creates customer loyalty. And the real estate often creates the long-term wealth. That's the economics of owning a movie theater. Anyone can fill a screen with a blockbuster. Very few can build a profitable business around the people watching it. If you enjoyed this documentary, subscribe for more deep dives into the hidden economics behind the world's biggest businesses. And if there's a business you'd like us to break down next, let us know in the comments below. Thanks for watching, and I'll see you in the next documentary.